a 12% premium. Shanghai is paying 12% more for physical silver than New York is pricing it right now. That gap is not a tax artifact. It is not a logistics delay. It is physical scarcity showing up in the one market that cannot lie, because delivery is mandatory. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver closed the week at $75.90 on COMEX. Shanghai Gold Exchange physical silver is pricing at approximately $84 to $85 per ounce. That is a $9 gap between the paper price and the physical price. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX registered silver inventory. According to Blowfin research data cited in the April 7th Finance Magnates analysis, COMEX registered silver, the metal that is immediately warrantable and deliverable against futures contracts, stands at approximately 76 million ounces. That is the deliverable pile. Against that 76 million ounces, there are approximately 576 million ounces of outstanding open interest in silver futures. That is a coverage ratio of 13.2%. The threshold that exchange analysts define as stress territory is below 15%. The exchange has been operating below that threshold for weeks. The registered pile has declined 1.9% in the past 30 days alone. 1.5 million ounces withdrawn from the deliverable supply in 1 month. This follows a period in which COMEX registered silver saw roughly 1/3 of itself pulled since the September 2025 peak. The timing is what deserves scrutiny, not the inventory decline in isolation, the timing, because it is happening simultaneously with a 12 to 13% Shanghai premium and a 6th consecutive annual global supply deficit. Think about what that sequence actually means. 3 separate data streams, vault drawdown, Eastern premium, structural deficit, all moving in the same direction at the same time. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time COMEX registered silver coverage fell below 15% for an extended period, silver was repricing rapidly. The data is already telling you something. Let's build it out. Now let's build the full picture, because the coverage ratio does not exist in a vacuum. The Silver Institute has published its 2026 market deficit projection. Approximately 67 million ounces, the 6th consecutive annual deficit in global silver supply. That data comes from the Silver Institute directly, not a secondary source. At the same time, according to CME Group daily warehouse stock reports, COMEX-eligible silver, the metal that meets exchange standards but is not currently designated for delivery, sits at approximately 470 million ounces. Eligible is not registered. That distinction matters. The conversion from eligible to registered requires owner consent and 24 to 48 hours of processing. In a rising price environment, eligible silver owners have a rational incentive to wait rather than convert, tightening registered supply further precisely when delivery demand increases. China's silver imports reached their highest level in 8 years in early 2026, according to Chinese customs data. The Shanghai Futures Exchange weekly warrant stock data shows low on-exchange inventories in China simultaneously. The rate of registered drawdown is not slowing, it is compounding. The data is doing the talking. The ones who were told the physical market was irrelevant because paper always sets the price, they are not saying much right now. And here is what makes that picture even harder to ignore. The U.S. 10-year Treasury yield is sitting at 4.29%, near a 3-week low, after the U.S.-Iran ceasefire announcement triggered a drop in oil prices and eased short-term inflation expectations. The U.S. dollar index, the DXY, closed the week at 98.65, below 99, down over 1% on the week. A weaker dollar is structurally positive for silver. Silver has historically exhibited higher beta to dollar weakness than gold. That means when the DXY drops 1%, silver tends to move more than gold does in percentage terms. At the same time, the Fed held rates at 3.50 to 3.75%. March CPI printed at 3.3% year over year, the highest since May 2024, with a 0.9% monthly increase. FOMC minutes from March explicitly flagged that the Iran conflict could require additional tightening. That is the structural tension. Dollar weakening, bullish for silver, inflation elevated, bearish for rate cuts delayed, headwind for non-yielding assets. But the physical premium in Shanghai is 12% regardless of where U.S. rate expectations sit. That is not a contradiction. That is the setup. And before anyone takes that as a green light to size in aggressively, setups can take a very long time to resolve. This structural picture has been building for months. The timing of when paper reprices toward physical is a completely separate question from whether it reprices. Anyone who claims to know the timing is selling something. Now the macro variable, because the US-Iran conflict and the Islamabad talks this weekend are no longer a backdrop. They are the primary variable in this market right now. Here is the number most people are not talking about. Approximately 21 million barrels of oil per day pass through the Strait of Hormuz. The strait remains partially blockaded as of this recording. A 2-week US-Iran ceasefire was announced April 7th. Vice President J.D. Vance arrived in Islamabad on April 11th to lead negotiations. The talks are active as markets are closed this weekend. March CPI at 3.3% is the first data point that captures what a partially closed Hormuz does to U.S. consumer prices, and it came in at the highest level since May 2024. If the Islamabad talks collapse, oil reprices above 115s, DXY reclaims 101, and the Fed's already constrained rate cut window closes further. If the talks produce a durable accord, oil drops toward $90, DXY slides toward 96, and December rate cut probability shifts from near zero toward 30 to 40%. Markets are still pricing the ceasefire as fragile and temporary. Look at gold refusing to sell off below $4,700 on a ceasefire announcement and tell me what probability you put on a clean resolution. When markets start pricing the reality of what a permanently disrupted Hormuz means for global inflation, silver reprices upward as a monetary hedge. Gold reprices upward as a central bank reserve asset. That is the historical pattern. Every time a major commodity supply route has faced sustained disruption, it has not been different yet. Silver Western Spot at $75.90, Shanghai Gold Exchange physical silver at approximately $84 to $85 per ounce, $9 premium, 12%. Short-term picture. Silver has posted 3 consecutive weekly gains. It is approaching the $76 to $78 resistance zone that multiple technical analysts identify as the next decision level. If that level breaks and holds, the path toward $82 to $85 opens. That is the level at which COMEX would begin to converge with SGE pricing from the western side. If the Islamabad talks collapse before Monday's open, silver faces a short-term binary outcome. Initial safe haven rotation could pressure silver on global growth fears. Then the physical squeeze narrative reasserts. If the ceasefire holds and the dollar weakens further, silver's industrial and monetary demand profile both benefit simultaneously. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. The weekend binary between a diplomatic breakthrough and a ceasefire collapse is not a tradable setup for most participants. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. COMEX eligible silver at 470 million ounces provides a large conversion buffer. A rapid registered to eligible conversion flood could temporarily normalize the coverage ratio and stall the squeeze narrative. March CPI at 3.3% keeps the Fed on hold, a headwind for non-yielding silver in a high real rate environment. A successful Islamabad accord could trigger an initial silver sell-off as war premium unwinds, and industrial demand outlook uncertainty rises on global growth rotation. The bull case is equally real. COMEX registered coverage at 13.2% is at documented stress territory, below the 15% threshold that historically precedes delivery pressure events. The Shanghai Gold Exchange is pricing physical silver at $84 to $85, a 12% premium that has persisted for weeks, confirming physical arbitrage is failing to close the gap. The Silver Institute projects the sixth consecutive annual deficit of 67 million ounces in 2026, with China's silver imports at an 8-year high, structural demand that does not disappear with a ceasefire. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. The structural pressure is already built into the physical market. The $9 gap between Shanghai and COMEX is not a forecast. It is the current price. The only question is whether paper catches up to physical or physical retreats to paper. Given a sixth consecutive deficit, 13.2% vault coverage, and 8-year high Chinese import demand, you run the math. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group Daily Warehouse Stock Reports at cmegroup.com. Silver Institute Annual Supply and Demand Data at silverinstitute.org. Shanghai Gold Exchange Benchmark Price Data at en.sge.com.cn. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.